Hello, everyone. Greg Sykora here. Join with me is Mark Zavitz. Today, we're going to quickly dive into model portfolio performance, talk about why your returns have been so strong, and give some opinion on if stocks are overvalued or not, and what we think might drive the next market pullback. So let's get started. So let's start with performance. When you get your quarterly September performance statement, I expect most of you will be quite happy. Your globally diversified portfolio, it's performing quite well. It's participating in the rally we've experienced since the Trump tariff April lows. Almost everyone owns either Templeton, or it's called a company called DFA, or Fidelity product inside their portfolios. And on an individual basis, all products are near top of their category. So for example, many of you who are in, say, like the moderate model, you own the DFA Global 60/40 fund inside one of your accounts. You might not know this, but there are about 1,300 products just like the DFA 60/40 fund to choose from in Canada. But of those products, the DFA product is beating 93% of peers year to date. The other big outlier inside your account that not a lot of other advisors do is add a gold weighting. Mark, maybe talk about gold performance, why we own gold for clients, and how much it's positively affected our model portfolio returns.
Well, Greg, for the last couple years, the bullion weighting has been phenomenal. So I'm not exactly sure what the year-to-date returns are. I know the one-year return for the bullion exchange traded fund that we have in many portfolios, the one-year return is about 44.5%.
Yeah, year to date.
Yeah.
Year to date, I think it's close to high 20s, or maybe even today, because it's up again, it'll be around 30.
Yeah, so that 5-10% slice that many people have in their portfolios, and predominantly, the 10% slice is for the very conservative portfolio. And then there's a 5% slice for the conservative and moderate, and some of the people in the growth and aggressive growth may not have any. Exactly. Because the equities are more aggressive stance, and they're in a more aggressive portfolio mix. But I have used bullion for 20 years, and since we've hooked up, Greg, for the last 4 years, we've included it in the 60 or 65% of the portfolios. We put it there for defense. We put it there for diversification. We put it there for a hedge. And it's just been wonderful, the positive performance. We never put it there to add 45%. We put it there as a hedge in the event that there were drawdowns against stocks. So yeah, it's really been quite positive.
Stocks and bonds, like it is a global uncertainty hedge. So yeah, whenever Trump says something stupid on a daily basis, basically, and either goes back to we're going to invade Canada, we're thinking of making Canada 51st state, or they revisit Greenland, or even like I think it was yesterday or the day before where they host a meeting where they declare war on the enemy from within by bringing in 500 generals and admirals and commanders and whatever. Those are all really positive for gold. Like, it positively affects gold performance because people get nervous, right? And for a while, gold about 15, 20 years ago wasn't like there was so little uncertainty in the world that after the global financial crisis, no one was really buying gold. But now that uncertainty has ramped up, specifically politically, owning gold has been like the best thing possible for almost everyone. Now, we don't want to own too much of it because like anything that goes up 45% in a year, it can also go down 45% in a year. So for many of you, as we meet, we're probably going to rebalance and potentially sell a little bit of your gold weighting over the next year. We've already kind of started for a few clients that are overweight, so kind of be ready for that. But in general, yeah, like it's been our best performing position.
Yep.
And of course, I mentioned that we're globally diversified. Most people's stock exposure, most client stock exposure, regardless of the model they're in, it's about 50% US, 25% Canada, 25% international. It's a big reason why we're globally diversified. We have no idea what's going to perform in the future, which markets are going to be leading the way. So we need exposure to everything at a low fee. We have a bias towards North America, obviously. It's like 3/4 of the portfolio, but we obviously can't count out as well Europe and Asia. Here's a slide showing total US stock return performance, and that's the orangish line you see there, versus international markets in purple. In previous years, the lines would be inverse. They'd be flipped. You'd see the US orange line on top and the purple line below it. And as you can see here, it's, international is leading the way. And that's why we own it. We don't know what's going to happen in the future. We're certainly glad we do own it for everyone. We have a 25% weighting. But will the party continue? Well, at least from what's known as to be a fundamental basis, at a fundamental level, there's no reason to believe, the stock market returns we've seen shouldn't continue. On this slide, you can see the second biggest tech stock in the world back in 1999, 2000. It was Cisco Systems. You can see how it appreciated in value, which is the blue line, relative to its earnings from 98 all the way to 2002 during the dot-com bubble. That company, obviously, if we compare it today to the biggest tech company, NVIDIA, it looks very different. You can see rising earnings on the right with NVIDIA. It's supporting valuations. Now, it's not just NVIDIA. If we plotted, say, Microsoft or Google there, it would have a very similar line. So two very distinct markets. One where you can see a bubble. This does not look like a bubble. The other noteworthy valuation measure that I look at on a regular basis, and I know Mark looks at too, is the CNN Fear and Greed Index. It looks at 7 different indicators. When things are frothy, when the market is overvalued and investors are taking on a lot of risk, potentially when they shouldn't be, this dial turns into the green or the extreme greed section. As of today, though, this is as of this morning, you can see it's reading neutral, which in my opinion is a very good thing, and it supports continued market growth. And finally, you might be reading in the news as of today or last night that the US government is heading into a shutdown. Well, have no fear. Traditionally, shutdowns, they don't really affect the broad stock market, at least in the US. On this slide, in the yellow bars, you can see are the worst performing individual stocks during our previous shutdowns. And of course, as you know, we don't buy individual stocks for you. We buy the market. But the blue bar, the broad market, the S&P 500, as you can see, over many government shutdowns, at least the US, ironically, the performance has been positive. So in my opinion, and we talked about this in our last monthly update, the biggest risk that we see coming up in the next month or two, it's not this shutdown because it doesn't really affect stocks, or it hasn't in the past. It's how corporations and corporate earnings are going to be affected by Trump, his tariffs, and the uncertainty that he throws at us. Mark, anything you want to add to this slide or any points you want to make?
Greg, it just supports being in the market. We'll have the odd client that will call us or contact us, and because of the media and the fear mongering about the shutdown and the implications, we're going to have a few people that are going to contact us, and we're going to have some other people that won't contact us, but they're going to be quite anxious, and they're going to be concerned about losing money. And we just need to remind people that you set these portfolios up, you hang on to them, and you make money over time. That's how you grow wealth.
Not exactly. Not dipsy doodling around trying to time when to get in and out. It's just owning it at a low fee and riding it out until you start drawing it for income when you retire.
Exactly.
All right, everyone. Thanks so much for tuning in and listening to our update. We look forward to giving you your next monthly update at the end of October. And feel free to reach out to us if you're feeling uncomfortable or want to talk or have a discussion about your individual portfolio or financial planning. Thank you so much.
Have a good fall, everyone.